Hi everyone, welcome back to Guild Index. Sorry, I took a little bit of a pause there. It's summer and I needed to enjoy the weather and catch a little bit of a tan. But welcome back. This is Guild Index. I begin as always with the index. In 2025, 78% of the value in New York evening sales at Christie's, Sotheby's, and Phillips was guaranteed before the auction even began. 78%. The price had already been set, the floor had already even been negotiated, and the work had already been committed. What you kind of witnessed in the sales room, the auctioneer, the paddles, the phone bidders, the tension even, and the hammer coming down, all of it was theater. The auction was already over. That number is actually from the Bank of America and Art Tactic 2026 US Art Market Report. It was published March 9th of this year. They described it as the high share of guaranteed value in New York evening sales in the past decade. The market, they note, is more reliant on guaranteed lots than ever. So the most important art market in the world in its most important sales is now 78% already pre-negotiated, and nobody in the room is actually even required to tell you that. In the stock market, there is actually a term for this, of what I just described. It is called painting the tape, and it refers to the practice of creating a kind of false appearance of trading activity, of demand, or even by buying and selling a security among a coordinated group in order to kind of attract other investors who believe that activity is genuine. The SEC defines it as form of securities fraud. It is very illegal and people do go to prison for it. And in the art market, the equivalent practice is called a guarantee, and it is legal, it is standard even. It is apparently 78% of the market by value. I want to be very clear and precise about what I am and what I am not arguing here. I'm not saying the art market is fraudulent in a criminal sense. What they're doing is quote unquote illegal. I'm not saying that at all. And I'm not saying the people running the major auction houses are criminals. What I am saying is that the mechanisms the art market uses to create the appearance of demand and therefore to establish and maintain prices are structurally identical to practices that are illegal in every other financial market, and that this has been true since Christie's opened its doors all the way back in 1766. And that the art market is the only market in the world where you can do this openly, legally, in front of an audience and charge them even a buyer's premium for the experience. And so let me show you exactly how it works. A chandelier bid is a phantom bid. It's not there. The auctioneer pretends to take a bid from somewhere in the room. There is no bidder, there is no paddle, there is no phone. The auctioneer is performing the existence of demand that does in fact not exist. The name comes from the idea that the auctioneer appears to be taking bids from the ceiling, from the chandelier, almost from thin air. Actually, until April 10th, 2022, New York City regulated this practice. Chandelier bids were permitted only up until the reserve price, the minimum the seller would accept at auction. After the reserve was met, only like real bids from real bidders were allowed. And the rule existed to protect buyers from the fiction of competitive demand when no competition actually existed in the auction room. On March 11, 2022, the New York City Council voted to repeal those regulations. They went into effect April 10th. The repeal was framed as a citywide effort to stimulate small businesses after the pandemic, and auction houses say they actually did not lobby for it. They also say, as the National Law Review documented, that they now have no legal obligation to disclose their financial interest in a lot, including whether there is a guaranteed minimum price, a loan to the consignor, or any other arrangement that would give the auction house a stake in the outcome. So actually none of that has to be disclosed. The auctioneer can now take chandelier bids at any price, not just up to the reserve. They can take multiple chandelier bids even, and as ArtNet's February 2024 analysis of auction theater documents, technically more than one specialist could execute a third-party guarantee, meaning instead of pulling bids from the chandelier out of thin air, auction houses employees can play act as a chorus of bidders representing only one. The result is a fake bidding war that makes demand look deeper than it actually is. The major houses, Christie's, Sotheby's, Phillips, have all said publicly that they intend to continue operating as if the regulations are still in place. And that is probably true most of the time. The point is not that they are actively running fake bidding wars tonight. The point is that they are legally permitted to do so, and nobody in the room has to be told, and the broader architecture of the auction, the guarantee, the reserve, and the estimate set deliberately below the reserve to create urgency, the third-party irrevocable bid, all of this is designed to perform demand. The chandelier bid is just the most visible piece of a larger theater. The guarantee is the more important mechanism. Before a major work goes to auction, a third party, perhaps another collector, a dealer, sometimes even the auction house itself, will agree to purchase a work at a minimum price if no higher bid is made. The seller is in fact protected. The work is, in a meaningful sense, kind of already sold to the auction house itself. If the auction generates higher bids, the guarantor takes a share of the upside. If it does not, the guarantor buys the work at the floor price that they set. This is a derivative, and this is an option. This is structured finance applied to a painting, and in 2025, 78% of the value in New York evening sales was running through the structure before a single paddle even went up. As the Bureau analysis of the Bank of America report notes directly, when guarantees blanket a sale, the auction itself becomes a price discovery event closer to a private negotiation than a public market. The public market is the performance, and the private negotiation already happened. You are kind of just watching the theater. You are paying the buyer's premium for your ticket. The gallery market operates on a different set of fictions from the auction market, and the most instructive case study for understanding those fictions is the Knoedler Gallery, which was actually founded in 1846. It made it through the Civil War, 2 world wars, basically the entire history of the American art market, and it actually closed in 2011. When it was discovered that the gallery had sold approximately $80 million worth of paintings that had actually been forged in a garage in Queens. The forger was a Chinese immigrant named Pei Xingqin. He was actually a technically skilled painter living in Queens who was commissioned to produce fake works in the styles of Jackson Pollock, Mark Rothko, Robert Motherwell, and other abstract expressionists. A lot of his work actually sold for more than the real works. The intermediary was a Long Island art dealer named Glafira Rosales, who claimed to represent a mysterious private collector referred to only as quote-unquote Mr. X, a man who supposedly had a collection of previously unknown masterworks that had never really entered the market. Between 1994 and 2009, Anne Friedman, the director of Knoedler, sold approximately 40 of these works for a total of around $80 million. What makes the Knoedler scandal specifically useful for understanding the art market is not the forgery itself, which is shocking, but the mechanism that made it possible. The gallery's credibility was kind of the entire product. Knoedler had been in continuous operation since 1846. 165 years of history, of serious clients, of impeccable reputation, and when Anne Friedman told a collector that a previously unknown Pollock had surfaced through a private European collection, the claim was believed, not because it was verified, but because it came from an institution whose history made verification feel almost unnecessary. The Providence story, the anonymous collector, and the mysterious origins none of it was really checked because the gallery itself was the credential. The institution was the authentication. And this is the deeper point about how the gallery market creates and maintains price. The primary market price of an artist's work, the prices set by the gallery for new work, is not a market price in any conventional sense. Rather, it is a declaration. The gallery decides what an artist's work costs. They do not obviously auction it. They do not set it through competitive bidding. They sell it, and then they really do just manage it. They decline to sell to buyers who may flip the work at a lower price and damage the narrative. They buy back work at auction when it appears and threatens to sell below the gallery price. They withdraw work from sale rather than allow a public price that contradicts the private one. The gallery price is a fiction of stability maintained by an active management. Olav Vilthius documented this in his 2005 book, Talking Prices, which remains the definitive academic account of how gallery pricing actually works. Prices tell a story about a trajectory. They are a constructive narrative, not market discovery. The Knoedler scandal is obviously the extreme version of what the gallery market does all the time. The institution's credibility is the product. The story is the authentication. The price is a declaration. Knoedler's version just happened to involve paintings made in a garage in Queens by someone nobody had even really ever heard of. The structural logic was identical though. The FOMO mechanism is not unique to the art market at all. Every financial market has some kind of version of it. When a highly visible, highly credible actor makes a public move, other actors respond to the signal, not because they have independently evaluated the underlying asset, but because the visible credibility of the first actor's interest makes the asset feel more valuable. You want it more because someone whose judgment you respect also wants it, or kind of appears to want it. The appearance is sufficient. The art market has understood this for a very long time and engineered it deliberately. The auction room is specifically designed to make you see other people wanting something. The art market has understood this for a very long time and engineered it deliberately. The auction room is actually specifically designed to make you see other people wanting something. The paddles going up, the phone bidders competing, the auctioneer's voice even climbing. Even when 78% of the value in the room is pre-negotiated, the theater of desire is preserved because the theater of desire is what makes the price real. The price is not the price because of the underlying asset. The price is a price because enough visible, credible people were seen to want it. The CNBC analysis of the May 2026 New York auctions, published May 14th, documents the contemporary version of this with a specific phrase I kind of want you to hold on to: new collectors looking for validation. Art advisors are explicit about it. Works that pass through the collections of the Rockefellers, Paul Allen, the Lauder family, the Newhouse family, those works carry premiums that have nothing to do really with the quality of the object and everything to do with the credibility of the prior owner. You are buying the validation of someone whose taste you trust. You are purchasing the evidence that someone who knew what they were doing already kind of wanted this. That is FOMO as a pricing mechanism, and the art market has been running it since the first aristocrat paid more for a painting because the king had considered buying it. The same psychology operates in every speculative market. Digital asset markets learned it explicitly, and regulators in those markets spend significant resources investigating coordinated activity designed to create the appearance of genuine demand where none really exists. The SEC has a term for it. The art market has a different term for it. The art market calls it provenance. The SEC calls it fraud. The mechanism is identical. The legal status is obviously not. And the Middle East angle from the May 2026 auctions is worth kind of noting directly, CNBC describes the Middle East as the kind of wild card for the current cycle. New money, new collectors, collections who, as Betsy Bicker of Citi Private Bank told CNBC, are buying because they understood the importance of the piece, which is to say they are paying for kind of the signal or the prior owner's judgment. They are buying the provenance as much as the work. The FOMO machine is operating kind of perfectly, and it has new cohort of buyers and a very old set of mechanisms. Here is what I want to say directly. The art market is the only financial market in the world where the practices that are criminal everywhere else are not just legal, but even celebrated as part of the cultural experience. The chandelier bid is theater. The guarantee is structured finance. The provenance premium is manufactured credibility. The primary market price is a declaration maintained by active management. All of these things in a securities market would generate SEC investigations, consent decrees, fines, and in some cases, serious prison sentences. And in the art market, they generate a buyer's premium of 25% on the first 600,000 and 12% above that. And again, I want to be precise about what I am not saying. I'm not saying the art market should be regulated like a securities market. I am not saying the people who run Christie's are committing fraud. I'm saying that the gap between what is legal in the art market and what is legal everywhere else is kind of extraordinary and almost really disguised clearly. The art market is kind of opaque by design. The opacity is the product. The confusion about how prices are actually set is part of what makes the prices feel real. If everyone understood that 78% of the value in the room was already guaranteed before the paddle went up, the theater would not really work. The theater only works because people believe it is not theater. The Knoedler Gallery sold $80 million worth of paintings made in a garage in Queens because the institution's credibility was sufficient to make provenance checks feel really unnecessary. The auction house can legally take phantom bids and does not have to tell you it's doing so because the theater of competitive demand is sufficient to make the price feel discovered rather than constructed. New collectors in the Middle East are paying provenance premiums for works that pass through the Lauder collection because the visible credibility of the prior owner is sufficient to make the asset feel almost validated. These are all versions of the same mechanism, creating the appearance of genuine demand in order to establish and maintain a price. In the stock market, the SEC calls this painting the tape. They send people to prison for it. In the art market, Christie sends you a very beautiful catalog. So that was the episode. That was Gilt Index, 78% guaranteed before the paddle even goes up. Chandelier bids now legal in New York without disclosure. A gallery that sold $80 million in forgeries because the institution was the credential. And the FOMO machine running exactly as designed on a new cohort of collectors who have not really even been told how the room works. So the art market is not fraudulent. It is just the only financial market in the world where the things that are fraudulent everywhere else are the standard operating procedure. And now you know how the room works. Thank you so much for watching. I hope to get on a more regular schedule. You can like, you can comment, you could subscribe. But again, thank you so much for watching. Bye.